The stock market has been dipping, and that is a big concern. For those of us old enough to remember the financial world of the 1980s, the faint echoes of a chill can descend on us in October. The chill usually goes away as quickly as it arrived, as stock markets go about their normal business of factoring in the economic and political events of the day. But, for some of us at least, the doubts still fester. Today, the stock market crash of October 1987 appears only as a small blip on the long-term charts. A minor buying opportunity, you might say, in the bigger scheme of things. At the time, though, it certainly didn't feel like it. Following so closely on the heels of a boom time for the City of London, driven by deregulation coined Big Bang and a government privatization program that delivered instantaneous profits to investors fortunate enough to receive their allocations, the crash was shocking. A large number of city workers at the time had seen nothing like it before. Quotation screens turned into seas of red. The phone lines stopped flashing, and high-frequency computerized trading took over for the first time as brokers slipped back home. People lost a good deal of money closing out their market positions. In those days, private investors could buy and sell shares within a 2-week period without ever having to pay for them. All that was required was the cash to cover a loss at the end of the period, if it occurred, or take the profit if it didn't. In the days following the crash, it felt like the end of an era. It was, however, anything but. Smart, long-term investors who rode the crash were soon back on top. As would turn out to be the case in future crises, the short-termers bore the brunt. The reasons for the crash were numerous, and blame is still apportioned differently, depending on who you talk to. However, the actions of central banks undeniably played a part. In America, interest rates were already well on the way up by the time of the crash. To counter the boom inspired by President Reagan's massive tax cuts of 1986 and a sharp increase in inflation. Fast forward to October 2022, and the investing landscape bears some similarities, but is by no means an identikit. While rate rises and rising inflation are once again the order of the day, the spring and summer was no boom time for shares and bonds. Quite the reverse, in fact. We are now more than 9 months into a bear market, in which the S&P 500 index in America is currently down by about 21%. A slow-motion crash of sorts. So, the questions occupying investors this October might have more to do with recovery. When will it happen? And how long will it take? But before we answer that question, make sure to subscribe to the channel for more similar content. Let's dive in. It's fair to say that 2022 has been a pretty tough year for stock market investors. Not only has the market been volatile, but many investors are seeing losses in their brokerage accounts and IRAs compared to the start of the year. And that can be very disheartening. If your investments have taken a hit in 2022, you may be wondering if 2023 will be a better year for the stock market. The quick answer? It's hard to say. Some factors that have led to increased volatility could settle down in 2023, thereby allowing stock values to recover. But even if that doesn't happen, investors who are sitting on losses in their IRAs or brokerage accounts today don't have to lose sleep over it. A big reason the stock market has been so volatile this year is that inflation has been rampant. Another culprit is the Ukraine conflict, which has put pressure on global supply chains and just plain put the world on edge. Both factors, however, could improve in 2023, and if that happens, a lot of people could enjoy a nice recovery in their portfolios. But we can't say for sure that inflation levels will start to taper off. The Federal Reserve is trying to make that happen by implementing interest rate hikes, but it still could take inflation a lot of time to cool. Plus, there's always the risk that the Fed's actions will spur an economic recession, and that could lead to prolonged stock market volatility. If you're seeing losses in your portfolio, you may be eager for things to change. But even if stocks don't recover in 2023, you don't have time to panic. Ideally, the money you have tied up in your stock portfolio isn't money you expect to need anytime soon. And so, if you're saving for a far-off milestone like retirement, you shouldn't worry if it takes time for the stock market to bust out of its slump. In fact, Let's imagine you're 30 years old right now, and you're assuming you'll retire at some point during your 60s. At this stage of the game, it really doesn't matter if it takes the stock market 6 months to recover from recent events, a full year, or 3 years. All that matters is that it recovers eventually. In the meantime, the best thing you can do to avoid long-term losses in your IRA or brokerage account is to leave your investments alone and wait for them to recover if they're lost value. If you sell off stocks in the near term due to panic, all you'll really do is lock in your losses. And if you're not desperate for money, there's no reason to resort to panic selling. Besides, cashing out a portion of your IRA early could have steep financial consequences. You'll be penalized 10% of your withdrawal amount if you take money out of that account before turning 59 and a half. Those penalties don't apply to withdrawals from a brokerage account, so you have more leeway there. But it's still best to leave your portfolio untouched while the market is down, so you don't lock in losses you may otherwise avoid. A number of factors reduce the likelihood of the creation of concentrated areas of risk in 2022. For one thing, the financial system is considerably stronger than it was a decade ago, thanks to greater supervision, stricter controls on the amounts banks must keep in reserve, and tighter mortgage lending requirements. It also seems unlikely, despite the rhetoric about being focused resolutely on inflation, that central banks would wish to preside over a deeper crisis as the world continues to come to terms with a post-pandemic environment of disrupted supply chains and already fragile economic growth. Given the presence of these safety valves, history suggests the current crisis of confidence in markets could be much closer to an end than a beginning. However, should a waterfall of tail effects eventually come to pass, the bear market may have a few more months left in it. As during previous crises, investors can navigate uncertainty using a few simple tools. Regular savings plans are an excellent way of combating the urge to time turning points in markets because they automatically accumulate more fund units or shares at low prices and fewer at high prices. Time and again through history, an unerring approach to saving regularly through difficult market periods has rewarded investors in the end, sometimes to a greater degree than if markets had traveled higher in broadly straight lines. Remaining diversified across asset type and countries is also a good source of action to take. Government bond markets have, like shares, been buffeted by changing expectations about inflation, interest rates, and economic growth so far this year. Ultimately, though, they tend to diverge from shares over time, helping to provide a buffer during periods of slow growth or recessions. A big reason the stock market has been so volatile this year is that inflation has been rampant. Another culprit is the Ukraine conflict, which has put pressure on global supply chains and just plain put the world on edge. Both factors, however, could improve in 2023. And if that happens, a lot of people could enjoy a nice recovery in their portfolios.